Everyone. So glad to see you here. Thank you so much for being here. Today is going to be a really good discussion on how to grow your rental property portfolio when you already have some rental properties. How do you turn the ones that you have into even more? This is a question that I get asked pretty frequently. Many times people will come up to me at conventions or when I'm teaching classes and they'll say, I already have two or I already have three. I just don't know how to grow it quickly. It feels like it just takes a long time to keep saving up money for the next one. Is there a better way to do this? So that's why I thought, you know what? Let's just talk about this for 30 minutes. Um, and what I would really like to do today is also hear from you. If you've got some ideas or some stories about how you've successfully done this, we can all learn. Just type it into the chat. If for some reason we run out of time today to get to your questions, I will send you an email or call you after our webinar is over. I promise to keep this right at 30 minutes today, so let's get started. Allow me to share my screen. Okay, hopefully you're in the right webinar and you came here to learn how to use the equity in your current rental properties to buy more properties. Another word that we use around here is the word doors or in the word units. Sometimes people use those interchangeably. So what that means is if there is an apartment building that has 4 apartments in one building, some people say that that's one property and some people say that that's 4 units. They might say it's 4 doors because there's 4 front doors. There's four different tenants that are renting space from you at that location. So today we're just going to talk about how to expand your portfolio. I am a KW MAPS coach. I've been a coach for 8 years. I've been a realtor for almost 21 years, and I bought 61 rental units. And I started that process, accumulating all of the ones that I have now in 2018, when everybody said, there's no inventory, you can't get any good deals. I'm going to wait for prices to come down. Well, I'm glad I didn't wait for prices to come down because I never did. And now what I do is I teach other people how to do what I did. I am a group coach for Fund Your Big Life with Rental Properties, which is a fast track to building your rental property portfolio. And you can find out more about it on fundyourbiglife.com. Today's webinar is intermediate level. I call it a mini class because my big class is like 1 hour a week for 8 weeks. So there's like 8 hours worth of content. So today we're clearly not getting into everything. What we are talking about is that specifically using that equity. And I call it intermediate level because I'm going to assume some things today. I'm going to assume that you already have one rental property or you already own a primary residence even. And I also assume that you know the basics of finding rental properties and methods to pay for them when you like purchase your first one. If you don't already know those things, come to my next webinar. My next webinar is going to be on how to buy your first rental property. So today is not going to go into that. Today's is going to be on these methods. I'm going to talk about the BRRRR method. I'm going to talk about using a home equity line of credit. I'm going to talk about using a home equity loan, which is a little bit different. And I'm going to talk about something called an all-in-one loan, a 1031 exchange, and a qualified opportunity fund. So those are the just a few things, a few different ways that you can leverage the equity in your current properties. And that's what we're going to go into detail on today. Let's start with the BRRRR method, also known as cash out refi. Cash out refi just kind of sounds more boring than BRRRR. And you can do a just traditional mortgage lender for these, which I've done those too. If you get a Fannie Mae loan, and I'm assuming you know what those are, depending on the bank you're going through, you can have up to 10 Fannie Mae mortgages. After that, you're going to have to go into portfolio loans at a small bank. That a lot of the banks also call them commercial loans, even though they're used to buy residential properties. So that's kind of confusing, and that kind of threw me off the first time I heard it. But when you call these local banks, you can say, I'm looking for a portfolio loan or a commercial loan to purchase or to do a refinance of a residential investment property. You may have to call 20 different banks to find somebody to give you the terms that you like. I did. I talked to 20 different banks. And just so you know, I'm in the Louisville, Kentucky area. And so I just called a bunch of credit unions and small banks, county banks. Like there's one called like the Harrison County Bank and the Meade County Bank. These are all small banks. Like so I suggest going there, because if you call, I've called Chase Bank and they're like, no, we don't offer anything like that. So that's why we go to the smaller banks. They are a lot more flexible and willing to work with investors on these type of loans. Here are a few of the questions to ask them. Now, there's many more, but I don't have time to go into all of them. But the first one is, what is the length of the loan term? Some of them are 10, 20. A few of them are 30 years, but usually you don't get the 30. I haven't found like a 30-year loan unless I go to one of those Fannie Mae mortgages with more traditional mortgage lenders. The smaller banks, what I found is pretty common is it's like 10, 15, or 20 years. Sometimes 25 years, some of them 25 years. And I take that back. I did find one that was 30 years, but that's why you call 20 to see who has the best options for you. Ask them, is the interest rate fixed the entire time? Sometimes the interest rate is only fixed for the first 3 years and then it adjusts with prime. Sometimes it's fixed for 5 years. But sometimes, like if you're getting a 10-year loan, they'll have it fixed for all 10 years. Sometimes they'll fix it for all 20 or 30 years. I've gotten them fixed for 30 years before with the Fannie Mae loans. So these are questions to ask whether you're doing that traditional mortgage lender or you're doing a small local bank. Ask all of these questions. Ask, is your cash out refi product based on the appraised value, or is it based on the purchase price, or is it based on the total cost? So all of those can be, I mean, it could be the same number, but it also could be completely different. So the appraised value means what an appraiser says the house is worth based on the comps today. The purchase price is the price that you paid for the property when you bought it. And the total cost is the purchase price plus what you spent on improvements. So one of the local banks that I called when I asked this question, the representative told me it's based on the total cost. She said, no, like we'll give you credit for doing your improvements, but we're not going to do the loan based on the appraised value. We're going to do it on what improvements you've done. And I was like, well, how do you determine that? And she said, well, you need to turn in your receipts. And I was like, every receipt, every time I went to Home Depot or Lowe's, every time I went to the flooring store? She said, yes. And we'll do an 80-20 cash out refi based on that. And I was like, well, that sounds like way too much work. Let's keep calling down the list. And I kept calling until I found someone that would do this product on a 20-year loan. And I did it like based on the appraised value. And they had different options. They had like a 80-20, a 75-25, or 70-30. And the rates were a little bit different at each of those levels. So the next question you want to ask is, will the loan be in the name of the LLC, or does it have to be in my personal name? I like for loans to be in the name of the LLC, keep things separate. And then you'll ask, is there a personal guarantee on this loan? Ask, what is the maximum loan to value? Like, is it 85%? Is it 80%, 75, 70%? What's the max loan to value that they'll do? And I said there's more questions, but that's all we have time for today. So just make sure before you proceed with this method that you do the math on what the payment will be after your cash out refi is complete. So we want to make sure that you're still profitable, that you're still getting $200, $300 per door per unit, even after you do this cash out refi. So don't proceed with it if you're going to lose money after completing the closing. All right, the next method we'll talk about today is a home equity loan. You can get this loan on your primary residence and use it as a down payment on an investment property. The home equity loan, usually you get all of it at once. At the closing of this loan, you go to your bank and they give you this lump check, this one check, and you put it into your checking account, and then you pay that loan back a fixed amount every month. And once you pay it back, you can't reuse it. You're just paying back this home equity loan. And that's a little bit different than the home equity line of credit. This is something you can also get on your primary residence. You also may be able to get on investment property. It's just not as common. It's a little bit harder to find that, but you can. But with the home equity line of credit, usually when I've seen these advertised and when I've used them myself, the rate varies periodically based on prime. It may go a little bit up or down, depending on your deal that your bank has either each month or each year, but it's going to adjust. And the payment that you owe is going to be based on the amount that's still due. So a home equity line of credit is like a credit card. You are only making payments on that balance that you still owe. So once you've paid it all the way down to zero, you can keep it open and reuse it, which is fantastic. Like, as long as you don't completely close it out, but you can reuse the whole thing. If you get a $50,000 home equity line of credit, which is what I did, I used it as a 25% down payment, $50,000 on a $200,000 fourplex. Now, what I had to make sure was, did the rent from the fourplex, was it enough to cover the 30-year loan for the 80%, for the 75% on the fourplex, and also was it enough to cover that home equity line of credit payment and still have some cash left over as profit, and still able to do the maintenance and taxes and insurance. And so those are all the things to consider. Can you cover all of the cost of owning it, including taxes and insurance and maintenance, and still pay these two payments if this is something that you want to do? Here are two things to think about, and these are the two reasons why some people choose not to do a home equity line of credit on their primary residence. So reason number one, danger number one, if you get a home equity line of credit for 85% of the appraised value, which some places you can, then what happens if home values drop 10%? What happens if you need to sell? You could end up owing more on your primary residence than you could sell it for, which is a terrible situation to be in. And we don't want you in that situation. So that's something to consider. And you don't have to take, even if your bank says, we'll do a home equity line of credit, a HELOC for 85%. You can say, well, that's great, but I only want to do it for 70%, just to protect yourself. So if you just do it for 70%, and when I say 70%, that means, that the HELOC, and if you have another primary mortgage on this, that those two things together are not more than 70% of the value of the house, the market value of the house. Just again, to insulate yourself in case prices come down, you need to sell. You wouldn't be upside down. You wouldn't be owing more than it's worth. So the other thing to consider with a home equity line of credit is, what happens if you use this to buy a rental property and your renter doesn't pay? Then what if you can't make your payment on your home equity line of credit? Then what happens? Well, I mean, now your personal home where you live is at stake. So this is why some people, they don't like this. They don't like having more debt on their personal home, their primary residence. But if you're completely confident in your market and in this decision, it can be a good way for you to use the money in your current primary residence without selling. Can you get a HELOC on your secondary home? Well, here is one option for that. Yes, you can. And you can also get something called an all-in-one loan. This is a product that I first learned about a year ago. I was working with someone at North Point Bank, and they said, have you heard about our all-in-one loans? And I said, no, I haven't. Tell me about that. They said it starts off as a purchase loan, and as you pay down the balance, you make your monthly payments, you can actually reborrow the equity if you need to use it later. So it starts off as a purchase loan and turns into a HELOC after closing. And you can use it as a checking account. And you pay each month, just like with a regular HELOC. You have your monthly payment that you make, but you pay on the balance that's still owed to the bank. So if you want more information on this, you can go to North Point's website. I don't work for them. I'm just letting you know that this is an option out there. And I've used it before. I used it to buy a house last year, and that's been really cool to be able to reuse that equity. This is it's a fixed rate. At least it starts off as a fixed rate. It might change after 10 years, but go to their website for more information on that. I haven't memorized all of the terms of it, so I'm just sending you to their website, northpoint.com, Northpoint with an E. You probably have heard of this before, 1031 tax-deferred exchange. You can use this to save on your capital gains taxes, defer your capital gains taxes if you need to sell a property in the USA and buy another one in the USA. with the profit. And I say in the USA because I sold my rental property in Costa Rica, and I could not do a 1031 tax deferred exchange because it was a foreign property, and I wanted to sell that property for a good amount of profit and use it to buy 4 other properties in the US. So I know that there was a lot of rules to follow, and I'm a realtor too, and every year I have to take continuing education classes. And you may or may not know this, but you can actually take continuing education classes on this topic. So it's a win-win situation. You get to knock out your continuing education hours, and you get to learn more about this important topic. You need to talk with your accountant about what steps you need to take so that when you sell a property in the US and you buy another property in the US, what is the paperwork you need to go through? Some people don't know that there is something called a forward exchange and a reverse exchange. In a forward exchange, you have 45 days after closing on your current property to identify a property that you want to buy. And this is called the replacement property, the one that you buy. And you have to close on that replacement property within 180 days from when you closed on the relinquished property, the one that you sold. And you have to go through a company called a qualified intermediary in order to do it. You're not allowed to touch that money. That money can't come to you at closing and then you go decide to do something with it. You have to have thought through this well in advance and put your paperwork and fill out your paperwork and have your qualified intermediary talking to your title company that's doing the closing well in advance. You can look for your replacement property before you put your relinquished property on the market that you want to sell. And this is called a reverse exchange. In a reverse exchange, you find a property before selling one. If you don't want to have to worry about finding the replacement properties and you're like, I just have too much to do right now, but I want to sell this property that I have, but it seems like a lot to try to find a replacement right now, you can put the profits from when you sell that first property into a Delaware statutory trust and use that as your replacement property. This is the part where I remind you of what's in red letters. Ask your accountant about this. I'm not an accountant and I don't know your personal situation, but I do know that this can be a really good tool for you to use when the time is right. So if you need to sell one because there's a lot of equity in it, or you just want to sell it because there's a lot of equity in it, to buy other properties, maybe the one that you bought, there's a lot of equity in it, but it's a headache and you just don't want to put any more time into it. You don't want to hire a property manager. This could be good for you. So write down 1031 tax deferred exchange, forward exchange, reverse exchange, and Delaware statutory trust as things for you to get more information on. Now let's talk about the qualified opportunity funds. So with a qualified opportunity fund, this is where I jumped the gun a little bit and would say, like, if you sell something in another country and you want to buy a rental property in another country and you're going to owe capital gains tax and you want to buy some rental properties in the US with it, this is a method you can use. A qualified opportunity fund buys businesses and rental properties in opportunity zones. Opportunity zones are low income census tracts scattered around the country. There's one near you. All you have to do is Google the words opportunity zone map to look for the area near you where they are. Sometimes you'd be really surprised. Like some of them are like really nice areas, but they're just low income areas. And they're areas where you can use this as a way to sell a property and then buy a property that maybe buy 2 properties and then bring in more profit per month. So this is a tax incentive that delays and reduces your capital gains tax on the rental property that you sold, that you had some equity in and you sold, wherever it is. It can be in the US or it can be outside of the US. Either way, you can reinvest the gains in these special areas around the country. And the longer you hold on to the properties that you buy with the profit, the better your tax incentives are. So there are different tax incentives if you hold on to it for 5 years, 7 years, and 10 years. In fact, on the IRS website, it says that after you hold that new property that you bought in the opportunity zone and you fix it up, you have to make it worth like you have to like make it worth twice what it was when you bought it immediately. As soon as you buy a property in an opportunity zone through an opportunity fund, you have to immediately like enhance it, like make it worth, like I was saying, double what it was. Because the purpose of this program is to take some areas of the country that are run down, where people haven't been fixing up the houses and fixing up the buildings and getting people to put money into those areas. So if you hold on to it for 10 years, there's potentially no capital gain on the appreciation, which can be huge. So it's not a good fit for everyone in every situation, but in some situations, it definitely makes sense to do it. And I've got the website on here on the screen for the IRS. If you want to take a picture or screenshot that web page, you can go there to get more information on the rules for the opportunity funds and opportunity zones. You can create a qualified opportunity zone fund, or you can invest in one that someone else created, the qualified opportunity fund. Or you can invest in one that someone else created. If you create and manage your own fund, there's a lot of IRS rules to follow, way more than I could talk about here. And I shouldn't talk about them because I'm not an accountant. So I'm just going to say, please talk with your accountant about this, research the rules extensively, but this is something for you to look into. Has anyone done this before other than me? Put it in the chat. Would love to hear your experience. So qualified opportunity funds can be for any kind of capital gains. It doesn't have to be real estate. Whereas like the 1031, it has to be, it's called like kind exchange. So if you're selling real estate, you're buying real estate, you're cool. But with the qualified opportunity funds, it could be other types of capital gains, not just real estate, that can be used to go into the opportunity fund and delay those capital gains taxes. Again, that's what I've been told and what I've read, but I'm not an accountant. You should ask your accountant. Okay, sounds like nobody else has done this before. So sounds like something that we all learned today. So this is the whole big picture. I just made a little map here. If you're just starting out and you don't even have your first property, you are here. You're at the very, very top of this picture. And you are just figuring out what is your plan, the path to the finish line. And you just don't even know how much is coming in right now into your income. You don't even know what your expenses are. So if that's you, that's step one. Very cool. Welcome. Glad you're part of this community. And then the next step, of course, is accumulating your first or second and third type properties after you've decided what type you want. Do you like condos? Do you like apartments? You want single family homes? And deciding where to buy it, blocking the time to look for deals, evaluating a deal, deciding on funding, buying it, getting it ready for renters, renting it out, tracking the profit, saving money on reserves. Then you're going to keep increasing the value so you can charge more for rent, getting advice from professionals. And then here's where we are today. This is what we talked about today, is this one, repeating those previous steps. So after you've gotten a few of your properties collected, you've saved the money to purchase a few, come back and rewatch this webinar on how to use some of the methods that we talked about today to purchase more. And then after you're tracking your profit, and you can see that even after paying for all these mortgages and expenses and maintenance on these properties, after a while, you're going to have increased the rents enough where you can hire a property manager and still have enough profit for you to pay all of your personal bills and your personal life. And I call that Financial Freedom Day, because you have the freedom to keep working if you want to. You can work from wherever you want to. You can travel with wherever you want to. You can hang out with whoever you want to, whenever you want to. It's total freedom when you have enough of these properties that the profit pays for your personal life. There's a lot of P's in that sentence. But after you've hired that property manager, that's what you get to do. And then you can keep working and pay off all these mortgages that we've just accumulated through the cash out refis and the HELOCs, pay them off and be debt free and financially free. Yeah, that sounds great. So that's what all of my classes are on, are the different steps here on this path. And today was just a sample of that. sample of this whole 8-hour detailed interactive group coaching class. Now, of course, we can't squeeze everything into our 30-minute mini class today. So if you'd like more information on the full class, just scan this QR code here that you see on the screen. And you can follow me on social media. I'm at Heidi Fore. If you have any questions after this class, you can find me online at Heidi Fore on all the channels and send me a question. And I hope I see you in the Fund Your Big Life with Rental Properties class. That's it's very detailed step-by-step system that you'll get when you're in the class. Does anyone have any questions about what we talked about today?
Yes, I have a question. I was
Great.
just wondering, along these paths that you created, where do you spend the most time in the class?
Each of the classes is on, it really just goes through the whole thing. There's not really one particular thing that's more important than others. So like one of the sessions in the class spends a whole hour on deciding what type you should buy, the pros and cons, and another entire hour is on where to find deals. Where in the country can you find the best deals? And then once you've identified a location in the country, what methods do you use to find the properties? So that's like a whole hour on that. And then we also spend a good amount of time in the class on if you decide to manage it yourself, like the checklist of how to maintain it. And once you have something, the checklist of once something's under contract, what do you need to make sure you do before you buy it? So there's a lot that goes into it. There's not one of these areas that is more than the others. What are you hoping to learn?
Oh, sorry. I have a question, 3 questions. One, do you allow people that aren't realtors to do this with you?
Yeah, absolutely.
Okay.
And they don't have to be realtors. They can be from any company, any industry, doesn't have to, anyone. This is for anybody who's thinking about buying rental properties.
Excellent. And then do you have an app that you use to help evaluate, so you can plug in the numbers to see easily that it actually could cash flow? Do you have one that you would recommend?
I do. I have 2. I'll put them in the chat. One is called Ballpark Deal, and the other one is called Deal Check.
Okay, very good. And then as far as I forgot my 3rd question. I'll come back.
Okay. Anybody else?
I'm sorry, where would you find these calculators? The deal park?
Yes, if you go to dealcheck.io or ballparkdeal.com.
Okay, thank you.
So ballparkdeal.com is a good app for your phone to very quickly run through a property to evaluate it, to see if it might cash flow for you, might have a good return. But it's not very detailed, but it's very quick. So if it looks good on Ballpark Deal, you'll probably want to go on your computer instead of the app. I just think it's easier to use on the computer screen. Go to dealcheck.io, not .com. It's dealcheck.io, and do that from your computer, like from your laptop or your desktop, and fill out the whole, input all of the data in there, and then go to their reports. And it's so much more detailed and gives you a really good yes or no based on your criteria.
There is an app I used called Property Evaluator. It's very detailed and can show the long-term, like if you do get out in a month, 2 months, 10 years. And when you see the 30-year, like what's possible, you're like, oh my gosh. So I would check that one out too.
Thank you. Great. Well, thanks for being here, everyone. And I look forward to seeing you in class. Have a great day.
Thank you so much. Thank you so much.
You're welcome. Bye.